let's be real for a second. Even if you follow the market closely, reading financial statements can feel, well, incredibly intimidating. You open up a company's financial report, and suddenly you're just bombarded with terms like revenue, net income, assets, liabilities, margins, and ratios. It is literally an absolute wall of corporate jargon. And after about 30 seconds of staring at that wall of text, your brain probably hits the panic button, right? You start thinking, yeah, maybe I'll just buy whatever people on social media recommend. It's such a common temptation to just blindly follow the hype, mostly because the alternative feels like you need an advanced finance degree just to understand what you're even looking at. But here's the absolute truth, and really the core of our explainer today. It's not as complicated as it looks. If you want to become a smarter investor, learning how to read these statements can completely change the way you look at businesses, and I promise you, no accounting degree is required. We're going to make this extremely simple and focus only on the fundamental basics you actually need to know. Okay, let's dive into this. Here's our roadmap. We'll start with the financial report card, break down the income statement, the balance sheet, and the cash flow statement, and wrap it all up with a smarter investor checklist. Section 1. The financial report card, understanding business health. Think of financial statements simply as a company's financial report card. They tell you how much money the company's making, what it's spending, what it owns, and what it owes. Basically, they help you figure out whether a business is financially healthy or struggling. And fortunately, there are really only 3 major statements you need to worry about. Just 3. Once you understand these 3 main reports, the fog is going to lift and you'll see companies in a totally different light. Section 2. The income statement. The easiest one to start with and the very first tool in our toolkit. So, what does this all mean? The entire purpose of the income statement literally boils down to answering one simple core question. Did this company actually make money? That's it. When you're staring at rows and rows of data, just remind yourself that you're simply trying to answer that one basic question. The very first number you'll usually spot is revenue. Revenue is simply the money a company earns from selling its products or services. Just think of it as the money coming in. If a coffee business sells lattes all day, the money those customers hand over to the barista, that's revenue. It is the top line of the business. Now, what's really interesting about this is that revenue sounds super exciting, but it absolutely doesn't tell the full story. We have to compare it against expenses. Businesses have to pay salaries, rent, marketing, and production costs. So after you subtract all those expenses, what's left? That is your profit, or as it's formally called, net income. This is absolutely one of the most important numbers you'll look at because it tells you if the business is actually making money after paying all its bills. Here's a really crucial beginner tip for you. Look at multiple years. Consistency matters. If revenue is growing and profits are growing too, that's usually a fantastic sign. But if revenue is growing and profits are actually falling, well, that definitely deserves your attention. You don't just want a snapshot of today. You want to see the long-term trend to know if the business model actually works over time. Section 3. The balance sheet, a financial snapshot. Think of this statement as a freeze frame of the company at a very specific moment in time. The balance sheet breaks down into 3 main parts. Let's swiftly translate this jargon into simple concepts so you feel totally empowered. First, assets. This is simply what the company owns. We're talking cash in the bank, buildings, equipment, inventory. Second, liabilities. This is what the company owes. Things like bank loans, debt, and unpaid expenses. And third, equity. This represents what's left over after all liabilities are removed from the assets. Basically, think of it as the true ownership value of the company. So, the crucial point is understanding the balance between these elements. Strong assets create value. More strong assets usually mean a stronger business. On the flip side, we have debt. Now, debt isn't inherently evil, A lot of great, massive companies use debt very wisely to grow, but too much debt, that creates massive problems, especially during economic downturns when sales might slow down. A strong balance sheet shows healthy assets, manageable debt, and overall stability. You always want to ask yourself, can this company comfortably handle its debt? Section 4. The cash flow statement. Real cash versus accounting numbers. This statement is vital. Why? Because sometimes a company looks highly profitable on paper, but actually struggles with cash, and that is a dangerous place to be. To avoid that trap, this statement answers, how does money actually move in and out of the business? We are talking about real, hard cash here, not just accounting figures that can sometimes be sort of smoothed out on the income statement. One of the absolute most important metrics you want to look at here is operating cash flow. This shows whether the core, day-to-day business is actually generating the cash it needs to survive and grow. Because at the end of the day, profitable businesses absolutely need healthy cash flow to stay alive. You can't pay your employees with paper profits, right? You pay them with real cash. And this brilliantly illustrates exactly why investors must cross-reference these different financial statements. If profits look fantastic on the income statement, but cash flow has been chronically weak for years, well, that's absolutely worth investigating. It is a huge red flag that tells you something might be seriously wrong under the hood of the business, no matter what those headline profit numbers say. Section 5. The Smarter Investor Checklist, bringing it all together to give you an actionable framework. Let's see how this all builds. When you sit down to analyze a company, just pull up this cheat sheet and ask these 3 core questions. For the income statement, is the company actually making money? For the balance sheet, is the company financially stable? And for the cash flow statement, is real cash actually coming into the business? If the answer looks genuinely strong across all 3 of these pillars, you're likely looking at a very healthy business. That's your foundation right there. You don't need to know every single microscopic line item, you just need to understand this big picture. But before you go out there, beware of these common mistakes. These are the real villains of investing. Mistake number 1, looking only at the stock price. A rapidly rising stock does not always mean a strong underlying business. Number 2, only looking at revenue. Remember, massive revenue without any profit can be incredibly misleading. Number 3, ignoring debt. Too much debt can totally destroy a company's ability to grow. And number 4, ignoring cash flow. Cash is the oxygen that keeps businesses alive. Never, ever ignore it. Think about the transformation we've just gone through in a few short minutes. Financial statements might look totally scary at first glance, but once you grasp these simple basics, they really become your most powerful tools. Because instead of guessing, you analyze. Instead of anxiously following social media hype, you actually start to understand the businesses you're buying. Leaving that anxiety behind for analytical confidence is exactly how smarter investors are built. So I want to leave you with this final, provocative thought. As you keep learning and practicing with these statements, I want you to shift your mindset. Think like an owner, not just a stock buyer. If you were buying the entire company yourself, wouldn't you want to know for sure if it's making real money, paying its debts, and generating cash? Of course you would. Start demanding those answers from the financial reports and watch how it transforms your investing. Thanks for joining me on this explainer. So, what's the first company's report card you're going to pull up today?